Gold hit a record this week. It reached about $3,707 an ounce after the Federal Reserve cut rates. But the price eased somewhat as the dollar strengthened and Treasury yields rose. London's gold miners fell about 2%. But does the rally still have momentum with risks looming? On Mining Metrics this week, it's a pleasure to welcome Robert Crayfourd, Portfolio Manager at Golden Prospect Precious Metals. Robert, thanks very much indeed for your time.
Thank you very much for having me on.
Well, look, markets were really eyeing what happens with the Federal Reserve, and they did it. They cut rates by 0.25% yesterday. What do you think the global sort of reaction was? It looked like it was mixed somewhat, but there was no definite signal coming out on whether this is a rate cycle. How did you take that in?
Yeah, well, look, I think the move into this has been pretty strong. I think very much a 25 bip cut was expected, and that's what we saw. And as a result, we saw kind of a pretty muted reaction across markets generally, and that included gold and the gold miners. We have seen it pull back a little, but that's probably entirely to be expected given the strong run we've had up into it.
Yeah, I was going to ask you about the reaction of gold. I mean, yes, indeed, we did see that pull back. But where does that leave the rally? Does the rally still continue?
Well, there's many drivers. As ever, sort of gold is hugely geopolitically driven, economically driven, and we've got to kind of pick between that. I think what's kind of interesting to see the commentary out of Powell in the sort of post meeting, and he clearly showed quite a focus on jobs data, less of a focus on inflation. So with jobs data having been weaker, it does point to more cuts, and clearly they're kind of keeping their optionality back, and they said they're going to focus sort of meeting by meeting. But yeah, I mean, the data we're looking at, ultimately does point probably to some rate cuts in the near term, but there's bigger issues like inflation. There's a real question mark about how that all plays out in that backdrop.
What do you think about the central banks buying gold? That's still continuing, and what's the factor there to influence its price?
Well, I mean, we think central banks will remain strong buyers of gold. When you get these kind of upticks like we've had in the last month or so, adding around $200 per ounce, maybe they do pull back a little bit initially, but ultimately, this shift to central bank buying really kicked off post the sort of Russian invasion of Ukraine and weaponization of the US dollar. And now under the backdrop of trade war and tariffs, etc., we just see more reason for central banks to continue to add gold and probably reduce treasuries against that.
There are some that argue that at this stage they really will be drawn to the ETF rather than the gold mining stock. I was wondering, what do you think about that, and where does that come from?
Well, yeah, I mean, we definitely think we're going to see more buying into the ETF and really into the physical ETFs. And we only really saw that kind of start sort of materially around the beginning of this year. So in reality, most of this rally that we've had in gold has been driven by central bank demand. Moving on from here, it's, we think ETF additions as financial participants, so sort of fund managers, etc., look to add precious metal exposure to protect against the broader economic risk that we're seeing. So we expect that to continue to be a driver, and we certainly saw that in the last quarter, and most likely going to see it in this quarter when the data comes through. So yeah, we definitely think that's going to be a material driver for the next leg, particularly under the backdrop of global debt, a real question mark around government debt sustainability, and we think that's now really fallen into focus. And just at the margin, we expect people to see incremental additions into their portfolios just to seek protection against that.
Yeah, because on the other side of the spectrum, it's just very interesting to see that there's still a struggle for the mining stock to catch up with what the metal is actually doing, right? Those rises seem to be lagging on the mining stock side.
That certainly was the case, and we've really been banging the drum on that for certainly the last couple of years. In the last few months, we've actually seen that reverse, and we have seen the miners outperforming gold. So we've seen a bit of that. So we've seen a bit of that leverage starting to really feed through, and I think that's hugely positive that we're seeing that. Ultimately, can gold go higher? That's the question mark. Stocks still are cheap, even though attractively valued, even though we've had a degree of catch up. valuations are certainly not stretched. They're certainly not aggressive. And if you focus down more towards the mid-tiers and some of the junior names where we focus, we really see some very attractive opportunities going forward.
Yep. Look, the other metals, silver, copper, also saw some record highs, Robert, in recent weeks. They pulled back slightly this week when that rate cut was announced, around about that time. What's your take, for example, on what copper is doing? That's an interesting metal, isn't it? Because it's a bellwether for many of what's happening in the future in these countries.
Yeah, Dr. Copper. Copper. I mean, we haven't really got long enough to kind of talk about it to give it the full time it deserves. But yeah, I mean, copper is more economically driven. As a result, we have a sort of degree of caution around that because we see general broader market risks. We think it's probably had a bit too much airtime around sort of electrification and AI data center demand, and not enough focus on the continuing property crisis in China, which we think there's a real drop there in demand that's still at the back end of feeding through into sort of net balances. Ultimately, we think people probably got a bit ahead of themselves around copper being the new oil, and as a result of being far more cautious, we've got a pretty low copper weighting still, and looking for more attractive valuations to kind of add back in. As much as we do like the medium term on this sector or on the commodity.
All right, and as I wrap up, Robert, look, with the rate cut, the Fed rate cut out of the way this week, I mean, what's the next sort of economic development that you've got your eye on as a fund manager that may just influence performance?
I think we're in a hugely sensitive time. I think every data point is going to be hugely important. I think very close eye is going to be focused, with very close attention is going to be put on any inflation data, especially in the US, and any jobs data. And whether we have any more loss of a Fed independence, because that's going to be a real concern for the market going forward. So I think there is no one data point. I think every data point is probably more important than it has been previously, and a highly sensitive time with, and Powell put it well, very uncertain, so very certain on the future paths and risk being elevated. So we would agree. Definitely see uncertainties, and every data point is going to be hugely important.
All right, no, we'll have to leave it there. Well, thanks very much indeed for your time, Robert. It was a pleasure speaking to you. Robert Crayfourd, there, Portfolio Manager at Golden Prospect Precious Metals. Thanks indeed.